This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click the red button over Arjun's picture saying, looking for the downloads. Now, Eric, let's start with crude oil and the EIA inventory.
EIA printed a drawdown of 1.5 million barrels of crude oil, Cushing, Oklahoma drawing down 220,000 barrels. The big drawdown was on gasoline, down 5.7 million barrels. Distillates building 888,000 barrels for a net petroleum drawdown of 6.3 million barrels. Meanwhile, U.S. production ticked down another 100,000 barrels to 13.1 million barrels. Really seems like there's a plateau forming there at 13.3 million barrels. That was the high print before the pandemic, and it's been the high print since the pandemic. I'd be very interested to see if we can get substantially above that at some point. The Keystone Pipeline status has changed so many times in the last couple of weeks, I can't keep track of it, and I admit I haven't been following it as close as I used to when I was trading oil more actively. Suffice it to say that the time spreads were coming off. They're starting to back up again. I'm guessing that's probably pipeline related, but I'm not on top of that news. So far, though, every test of the 34-week moving average just below $80 on WTI has failed. As of the close on Wednesday, we're just barely back up above it. It'll be interesting to see whether or not we can sustain that level and move on to a meaningful rally above $80.
Well, Eric, this morning we do have a breakout above the $80 level. It's still unknown whether they will be able to hold that breakout by the end of the day. But overall, crude oil has been progressing higher highs, higher lows. The bottom really did establish itself in December. It's been trading above its 50-day moving average for over a month and really just needed a breakout out of this trade range to kind of open that upside. At this stage, if the breakout holds, I'm looking for $85 on the upside in the most immediate future. The fact that RBOB gasoline is breaking up, we'll talk about that chart in a moment, I think just continues to support that case. All right, let's dive into the equities. I want to get all of your opinions, but Eric, let's start off with you.
Louis Vincent Gabb's words ring true in my mind. It feels like 1999 all over again. It's easy to make lots of good arguments for a downside reversal, but the market just keeps on melting up to new all-time highs anyway. When this happens, it usually continues to melt up for longer than most of the smartest people in the room thought possible, and then eventually crashes abruptly, as it did in March of 2000. For now, we're still in the melt-up phase. I have no idea how long it will last.
So spot price right now on SPX is approximately 51.65. We have a call wall above at 5,200 and a put wall below at 5,100. Now the implied move for the April 19th monthly OPEX is plus minus 150 points. Therefore, the upper implied move is 53.15 and the lower implied move is 50.15. Right now, we have key resistance above at 5,200 and key support below at 5,100. I'm inclined to think that we see a swing higher, swing low based upon the FOMC, which takes place next week. Powell's commentary will be very, very key in determining where we move from here.
Yeah, when I look at that chart, Nick, we continue to see the same pattern. The price action is bullish. The bulls remain in control of the trend. Higher highs, higher lows. Every dip gets bought. It's an upwards channel that's been in place since January. And the market is relentlessly rising now towards some of these different hourly measured moves that approach 5,300 on the upside. So we have a trend that's in place very strong. On page 5, I have where that 50-day moving average is around the 5,000 level. This trend has been so strong that even a 250 S&P point pullback, like you were suggesting, a couple percent, would find support right along an uptrend moving average like that. And so there's a lot of technical damage that has to happen in order to shift this trend. Typically, that is associated with topping formations and other types of things that would be associated with a pivot in the trend. That just hasn't emerged. Maybe next week's news might be the catalyst. Right now, the ascending trend line approaches 5,200. That would be like the first kind of support line that we'll be looking to see if it holds. But right now, we have to respect the prevailing trend, knowing that inevitably that market correction is around the corner. And when it is, I actually think it'll be deeper. It could easily be of the 5 to 10% variety where we could see 400, 500 S&P point pullback, but there's no sign that it has begun now. Moving on to the NASDAQ, what levels are you watching here, Nick?
So right now the spot price on Qs is approximately 440. We have a call wall above at 445 and a put wall below at 430. The implied move for the April 19th monthly OPEX is plus minus 19 points. Therefore, the upper implied move is 459, which would mark new all-time highs. And the lower implied move is 421. Right now we have key resistance at 450 and key support at 430. As I mentioned last week, I'm bullish on certain names, namely Google and Apple, because they pull back nicely off their highs. Right now, Tesla is breaking down and could see as low as 150 in the short term. NASDAQ on Friday had a significant pullback from a high of 975 all the way down to 850, which was a crazy pullback intraday, causing the market to go from green to red. But I think that being selective with the names you choose is very, very important going forward, because certain names are very overextended, while certain names are very undervalued, namely Apple and Google, in my opinion.
It's interesting you mentioned those names, but really all eyes turn to NVIDIA in my mind. If NVIDIA cannot continue its trend and break to a higher high after this pullback, then that will be a huge drag on the entire index. And so over the next coming days, watching whether the bulls actually buy the dip here on NVIDIA and get this north of 920 and get it really running back up to the highs, maybe even testing 1,000, I think that's necessary for this bull trend to continue. Otherwise, it will be a damper on sentiment as well. Nonetheless, let's talk that volatility index trading back on the 13 handle. What are the levels you're watching here?
So right now with the VIX at about 13.5, we can expect intraday moves top to bottom of about 0.85%. Again, I don't see much changes from last week where we're seeing a lot of put selling on pullbacks and call selling on pops. This should continue into FOMC until we get a clear direction, either up or down. And moving on to page 8 on the U.S. Dollar Index, what are your thoughts here, Eric?
The big question on my mind this week has been whether or not the second hot CPI print in a row would breathe a new upside enthusiasm into the Dixie as more traders begin to anticipate the possibility of the Fed's rate cut plans maybe being put on hold until after the election. But so far, I don't see any of that. As Jim Bianco told us, it's going to be June or never for the Fed. And I think the biggest factor affecting the dollar will be how market expectations develop going into the May and June FOMC meetings. I don't see any possibility of rate cuts starting at next week's March FOMC meeting. But if that happened, it would likely bring a lower dollar.
The dollar remains right in the dead center of its one-year trade range. And really at this stage, I don't think there's going to be any big indication of a dollar move until we get past all the central bank meetings next week. And so really at this stage, it's just a matter of holding out, seeing whether the 102.5 level holds, which is a Fibonacci retrace level, and whether or not the central banks next week are a catalyst for potentially starting some sort of a trend move.
Now moving on to page 9, we have the gold futures chart. What are your thoughts here?
The first meaningful correction in the massive bull move in gold is finally upon us. I predicted last month that a second hot CPI print in a row would cause gold to take a nosedive, and that's exactly what's happened. As Patrick said last week, the play here is going to be to buy the dip. The question is how far we have to go to the downside before the bull move continues. To my thinking, the range of possibility is as follows. A correction down to the 38.2% fib retracement level would take us all the way back down to 2,115, 2,115 on the April contract. And that's as low as I could imagine this correction running, unless there's a surprise rate hike or some other hawkish surprise. The other end of the range is that the bottom could already be in at 2156, the level that gold touched in the hours immediately after the CPI data came in, and which, by the way, was a perfect test of its 8-day moving average. So my feeling here is you want to try and buy this correction as close to its bottom as you can, with the range of possibility ranging from you already missed it to hold out for 2115, 2115. I can make either argument. On one hand, the slow stochastics are very, very high, very overbought, and have already rolled over to the downside, suggesting a further downside correction still lays ahead. On the other side of the coin, the move up was so exuberant that I see plenty of room for emotion to take us even higher, notwithstanding the worsening short-term technicals. And all it would take is a little monetary policy news in either direction to change that outcome. Patrick, I'm very curious to know your take on the levels to watch and where you would start buying this dip if you haven't already.
Eric, there's a simple rule in technical analysis where what were previous overhead resistance levels now become support. And with the fib retracement level sitting around the 2100 area, I think any pullbacks in the $50 to $100 an ounce area are the tactical buy on dip areas where you have some asymmetry.
Now, Eric, last week you were talking about the buy on dip on these pullbacks on uranium. What are your thoughts here?
I'm still super bullish on uranium, medium to long term, and I'm getting more optimistic that one final push lower to the 200-day moving averages is still to come before this correction is over. Cameco almost touched its 200-day moving average on Wednesday, and Sput put in a new cycle low Wednesday. Several of the other mining stocks broke their 100-day moving averages to the downside, which until now have been holding the market up. And that suggests that lower numbers are still to come. As I've said before, I welcome a deeper correction as an opportunity to buy more uranium and uranium miners at lower prices. And at this point, I'm not in a hurry to rush out and do that. The 200-day moving averages are still well below the market on most issues, and I'm going to wait until we get closer to them before I continue to buy more shares. The potential upside catalyst on the horizon, and it's probably still a couple weeks out, is legislation now being mulled by the U.S. Senate, which would outlaw the import of Russian uranium products. The politicians are just virtue signaling to their constituents, teach that stinking Putin a lesson. Well, in reality, the fact of the matter, whether you like it or not, is we need Russian uranium imports more than we need whatever benefit the sanctions would supposedly afford to us. So the Senate legislation has been crafted to allow generous exemptions to keep the necessary trade flowing even after the symbolic gesture of imposing sanctions has occurred. But the fear in the industry, and it's a strong one, is that Putin will respond by saying, oh yeah? Well, forget your exemptions. If you want to play this game, we'll just ban all exports of uranium products from our side, and the West will be cut off, no exceptions. If that happens, it will spell much higher domestic uranium prices, and it will cause a conversion and enrichment shortage crisis of epic proportions. In my opinion, the Senate is playing with fire here, and the potential outcome of their arrogance could be much higher uranium prices. But this legislation isn't likely to even reach a vote, never mind passing, for at least a couple more weeks. And during that time, I'm optimistic that we'll see lower uranium prices than we have today, and therefore better buying opportunities.
Yeah, Eric, this pullback on uranium has, really accelerated here on the very short term, but it still meets all the criteria of a typical secondary corrective move in a primary trend. And I'll agree with you that this should be bought on dip here, and particularly these levels on the Sprott Physical Uranium Trust, and this one's the one on Toronto. Buy levels are anywhere near this $25 area is a tactical place to put some of that trade on. I wanted to leave it off by looking at the chart on copper. And I've been far more neutral on copper since it's been in that trade range that's been established since the second quarter of last year. And here we are with a breakout now to highs that we haven't seen since the first quarter of last year. And so the big question here is with this kind of China stimulus story coming about, did we see the bull breakout here in copper, and is copper at this stage destined to retest its January highs? It's certainly a bullish breakout, and we want to now see if the bulls can now follow through. The most disappointing thing at this point would be if the bulls let the selling give it all back and get it back below the 50-day moving average. But I think that that's an outlier. At this moment, any pullbacks, like we talked about in gold, any pullbacks in copper can be initially bought here with targets toward the 4.25 on the upside.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.